This session of RSM Tax Summit Week is Planning During Uncertain Times, Tax Trends and Issues Affecting Individuals and Business Owners. At this time, I'm pleased to turn our call over to our first presenter, Karen Costa. Karen?
Welcome, and thank you for joining us for our Tax Summit, and thank you for being with us today for Planning During Uncertain Times. As you just heard, my name is Karen Costa. I'm the leader of our National Family Office Advisory Center, and I'm joined by Ben Berger, who leads our Family Office Tax Practice nationally, Andy Swanson, who's a member of our Washington National Tax Practice and also leads our Business Owner Practice, and also Krista Clark, who's the leader of both of our investment fund and our fund executive practices. Let's take a quick look at our agenda. And just as the title suggests, this is very uncertain times. And after putting together the agenda and preparing for our presentation, we were presented with a new tax proposal. So we're going to stick to the agenda, but before we jump into that, we're going to turn it over to Andy Swanson, who's going to cover some of the highlights and topics from the new proposal, and then we'll get started. So Andy, I'm going to pass it over to you.
Thanks, Karen. And, you know, I think the most current event that we're dealing with is we need to wish Karen a happy birthday. Found out this morning, today is Karen's birthday. So everybody, please join us, and hoping she has a fabulous day today. So Karen's exactly right. When we finalized this presentation, Kirsten Sinema was telling us that I'm not going to sign a bill. I'm not going to vote for a bill that includes increases in rates. Of course, increases in rates are really what drives kind of the pertinence of some planning. So we made a decision to pull a couple sections out of this deck. Of course, 2 days after we made the decision to pull those out of the deck, we got a proposal out of the House that included not rate increases, but surtaxes, which had the exact same effect. So there's a couple of planning ideas we'll talk about here during current developments, and then we'll get on to a little bit more of the meat of the presentation. But, you know, the big items right now are, number one, the SALT cap. The proposal that came out this week finally had something to do with the SALT cap. Of course, TCJA limited our SALT deduction to about $10,000. Now this proposal would increase it to about $80,000. There's a lot of talk that once this gets to the Senate, that will change, but at least that's the way that it sits today. As I mentioned in the lead up here, surtaxes are kind of the name of the game right now. So with the ACA, we encountered the net investment income tax, a 3.8% tax on investment income. One of the provisions in this bill would subject all income to that 3.8% tax, provided it's not subject to FICA, right? So that would exclude things like wages and stuff of that nature. Also excludes some items that you wouldn't think about, like deferred compensation and retirement plan distributions. That starts to kick in at $500,000. At $600,000, all income is subject to that 3.8% tax. We also have a 5% surtax on AGI over 10 million. So that means this tax will not be reduced by itemized deductions. And then another 3% tax on AGI over 25 million. So really trying to increase rates on those very high income taxpayers. The other two provisions that we're talking about quite a bit are excess business loss provisions. This was a product of TCJA. Basically limiting our business losses to $500,000 on top of your business income. So that means items like wages, interest, dividends can only be offset but to the extent of $500,000 of business income. And then 1202, qualified small business stock exclusion. There's a provision in there that would limit that exclusion to 50% of the gain for those taxpayers with over $400,000 worth of AGI, which really, you know, for the most part, just limits it to 50% because most transactions are going to push that AGI over that $400,000 limit, pushing you into just a 50% limit. So if we think about what does this mean to you, you know, the SALT cap, should this come into play, it is effective for 2020 under the current provisions. That means that here in December, we're back to the rules the way that we kind of looked at it back in 2016. If you haven't paid that $80,000 in state and local income taxes, we probably need to figure out before December 31st how much you owe so that we can get the deduction. So that's what that one means. Surtaxes, the biggest thing that comes into play here is entity choice, as well as acceleration of income into 2021. So we're probably going to see a lot of planning here over the next couple of months, looking at ways that we can pull income into 2021 where those surtaxes are not applicable, and maybe push deductions into 2022 when they are applicable, trying to gain really a little bit of permanent rate difference on some of those items. The last item is really entity choice. As I said before, we pulled at least one planning idea out when we heard Kirsten Sinema say that rates weren't in play for her. One of the biggest items there was entity choice. So we think about it, we've got a full all-in rate of 48.8% on flow-through entities if your income at the individual level is above 25 million. If we look at a C corporation in that same boat, it's going to have a 21% corporate rate and probably about an 18.8% individual rate if we were to distribute all income out of that corporation, adding up to about a 39.8% all-in rate. That may be enough to flip the switch and make a lot of people start thinking about C corporations, where historically flow-through entities have really been the best way for them to do business. So that's really what I have here for current developments. I'll turn it back over to Karen to talk or I'll turn it back to Krista and then pose the question to her as to entity choice. Is that meaning anything in kind of the investment fund and fund executive world?
Yeah, thank you, Andy. And by the way, happy birthday, Karen. But yeah, so, I work a lot in the asset management space, right? I work with fund executives, fund managers, and I know, Andy, a lot of those people have a sigh of relief right now to hear that the carried interest is not in that overview you just gave. So thank you for that, although we still need to deal with the 3-year holding period for the GPs, right? But yeah, I would say what's really interesting is the proposal for the net investment income tax, because that is certainly far-reaching, and it's a little less intuitive than these broader rate increases or surtaxes, as you mentioned, which certainly do still provide for an opportunity to do that reverse tax planning, right? Accelerating the income. But as Andy mentioned, this updated 3.8% net investment income tax expansion, it would now include the non-passive operating income from businesses like a management company or in your portfolio that are not already subject to the self-employment tax, regardless of whether the taxpayer materially participates in that business that generated the income. So for example, guaranteed payments for services, right? We would generally, those are already subjected to this self-employment tax. So just to be clear, there's not an additional 3.8 on top of those. However, depending on your business structure, for example, a limited partner in a partnership may have been relying on the rules related to the exclusion from self-employment tax. So now that distributive share of income, right, that goes above and beyond the guaranteed payment, that was not subject to the self-employment tax and now will be subject to this expanded net investment income tax. And the same goes for the gains from sales of certain portfolio companies. The proposed rules really include gains from the sales of those business assets used in a non-passive business, as well as gains from the sale of S-corps and partnerships. So it is far-reaching, and many asset managers are looking for ways to accelerate income, like I said, or defer expenses, both at the fund level and the management company level. So things that you wouldn't ordinarily think to do, right? Like disguised partnership sales, or actually triggering negative capital accounts, or canceling debt. So any technique that would be helpful there to accelerate that income and save the deductions for higher rates will be beneficial. So I'm going to turn it to Ben. Ben, what are you seeing with your clients?
Great. Thanks, Krista. I'll join my colleagues in wishing Karen a happy birthday as well. Happy birthday, Karen. I spend a lot of my time working with family offices, and entity choice is a real issue with respect to family offices as well. Oftentimes you have a family office that is structured with the funds that hold all the investments and then a management company. And the question is always, how do you structure that management company? Should it be a pass-through? Should it be a C corporation? And there are a lot of tax and non-tax considerations to come into that. But as we think about, potential increases with the surcharge, the net investment income tax that my colleagues have already spoken about, that the individuals and trusts would be subject to. And then on the flip side, you have the C corporation that's still holding steady at 21%. Yes, of course, there's an added tax, or a double tax, if you will, for the dividends that come out of the C corporation that obviously has to be considered. But the tax itself on the income at the C corp is only 21%. And so it's another compelling reason to use a C corporation as a family office management company. But there are pitfalls there as well. You have to think about the accumulated earnings tax, where you can't just accumulate income and accumulate assets into a C corporation in perpetuity and never make any distributions or investments inside of that C corporation. So you do have to think about that. You also have to think about the governance. You have to think about the flexibility of the C corporation. It is somewhat inflexible versus a partnership or an LLC taxed as a partnership. So all of those things have to be considered. But if you're looking from a tax rate differential, it's really a compelling argument to go the C corporation route versus the pass-through. So that's what we're seeing on entity choice. I think the message there is you have to model this out. You have to take a really deep dive into the financial analysis and forecast what this is going to look like over a period of time and stress test this before you make any final decisions. Karen, I think we're back to you.
Thank you all. We're going to move over to our first polling question. So thinking about our potential tax changes, what are you most interested in hearing about today? The mark-to-market, which was part of the billionaire's tax, changes to grantor trust rules, which I know has been really big, changes in tax rates, or changes in lifetime exemptions. I'm just going to hold here for a moment while you make your selections. It's interesting, we did do this polling question before the most recent policy has come out, so bear with us as we're still referencing the billionaire's tax plan.
Yeah, there's always a chance one of these could come back into play though, right, Karen?
That's right, that's what we're hearing, so don't count anything out. That's right. So I'm going to go ahead and advance the slide. So changes in tax rates, that takes the win. So I would agree with that. We're hearing a lot of that with our clients. We're hearing a lot of that as we think about entity choice and what our comments were just previously about the acceleration of income. And so that's pretty consistent to what we're hearing. So we're going to go ahead and move on to the next topic that we have planned for you today, and that's charitable planning. Ben, I'm going to turn it over to you to give us some high-level topics and considerations. And so with that, I'm going to let you take it away.
Great. Thanks, Karen. Talk a little bit about charitable planning as well as, things that we're seeing with our clients and things that we're talking about with our clients between now and the end of the year. First point, I think, Karen, you can move the slide, is lifetime versus post-mortem planning. And this is an interesting slide that we put together, and there are some assumptions built in here. But, we start with the assumption, that a family has charitable inclinations and charitable objectives. And it is really important to quantify and to put a formal strategy together for a family's charitable objectives, what they're trying to accomplish. But we work with many families that accumulate assets during their lifetime only to have the majority of those assets given away at death. And there is a compelling argument to take a fresh look at that and think about, does it make sense to make significant charitable contributions during lifetime versus growing those assets during lifetime and donating a majority of them at death? In an analysis that we did, ultimately, aside from the income tax savings or the current income tax savings that you have during your lifetime, you're also reducing ultimately the size of your taxable estate. And so we think that kind of conservative basis, you would end up providing 59% more cash or more assets to charity by doing more during your lifetime than at death. So again, just something to think about, and something again to run the numbers and run the analysis. It's pretty compelling when you're looking to maximize the value of the dollars going to charity. A few other quick hit items on charitable contributions. Don't forget that the 100% AGI limitation for cash to public charities is still in effect through the end of this year. So normally there is a much more significant limitation on charitable contributions made during the course of the year. For this year, and under certain circumstances, when donating cash, you can donate and deduct up to 100% of your gross income. And so we've had clients take a look at things like, converting an IRA to a Roth IRA and then offsetting that with charitable contributions. If you recall, in the Ways and Means Bill, one of the items discussed was the elimination of the ability to do some Roth planning or some IRA planning. And so clients are being a little bit more aggressive and taking a hard look at, does it make sense to convert an IRA to a Roth, and then perhaps offset that income hit with a significant charitable contribution. We're also seeing, a lot of M&A activity and a lot of businesses that are going through liquidity events, and there are some opportunities there to offset that with some significant charitable contribution deductions. One idea that we've used with several business owners this year is the use of a charitable lead trust. A charitable lead trust, in a nutshell, is a powerful vehicle where you contribute assets to a trust, and then over a period of years, there's an annuity that's paid to a charity of your choice. And at the end of that term, whatever remains in that trust can go outright to children, descendants, or a trust to benefit your children. If done right and done properly, charitable lead trusts can provide for a very significant tax deduction, as well as some really powerful estate planning. So as a quick example, if I were to put $10 million into a charitable lead trust today and provide for an annuity over 15 years, if I assume a 7% growth rate, there would be about $12.5 million left at the end of those 15 years that could go gift tax-free to children, grandchildren, or future descendants. And at the same time, I would receive a full $10 million deduction today to offset a large income event, say a sale of a business or something like that. So particularly for businesses that already have LOIs in place, where it's too late to perhaps shift or make a contribution of some of that business interest into a charity, the use of a charitable lead trust is a really powerful vehicle. Don't forget also, I know that Andy, you mentioned the surtax before. The surtax that we've talked about, or that's been proposed by Congress, that extra 5% or 8% surtax, that surtax is on gross income. It's not on taxable income. And so what that means is the surtax is not impacted by charitable contribution deductions. And so charitable contribution deductions, if you're in that surtax bracket, are not going to reduce the amount of that surtax. And so the point there is making a contribution this year is the same from a tax savings perspective as it would be next year, because as of today, income tax rates themselves, ignoring the surtax, are not scheduled to increase. And so from that perspective, it may make some sense to accelerate some charitable contributions this year versus delaying to next year, especially if a taxpayer has significant income this year to offset. Finally, we're seeing a lot in the area of using unique assets for charity, business interest, private equity interest, et cetera. Andy, why don't I turn it over to you to talk a little bit about that, and then maybe we'll hear from Krista as well as to what she's seeing in that area.
Yeah, I'd say, over the past year, I've encountered no less than like 4 or 5 different clients that, business owners, their largest asset is a family or business that they started. their desire is to leave that business to charity, either through a private foundation or something otherwise. And, I'm not going to pretend that I know all the rules related to this because it gets extremely complicated. You've got to have the right people involved in order to figure some things out. You can get there, but I wanted to kind of issue a warning that if this is your desire, it's important that you pay attention. Also from a tax standpoint, not just from a tax standpoint, but also from a governance standpoint. Many of these situations, you don't want the charity to be in control of the business, so you have to take extra care to make sure that you have proper governance in place in order to ensure that the business continues to be run the way that you want it to be run. But that was something that's kind of popped up this year that, quite frankly, I'm not so sure I had ever dealt with before this year, and then it just kept popping up. So that was something that I wanted to bring up. I'll turn it over to Krista. I don't know if you have anything you want to add to that.
Yes, just from the perspective of someone who's invested in a fund, right? An investment fund with underlying corporate stock in the portfolio, I would say one more thought to consider would be a very basic, classic planning opportunity, which is to make property distributions of low basis stock from the portfolio. So to the extent you can do that, because you're not triggering gains. So to Ben's point, you might be thinking to accelerate some of these gains, right? Like we talked about accelerating income, but now how do you offset that with charity? And so if you are distributing stock, you generally are not triggering gain, and then taking that stock, but donating it to charity at the fair value, right? So you're not getting taxed on the gain, you're donating it at fair value, reducing the liability. And I mean, you could even I love to use the donor advised funds, right? Because you could bunch the deductions into a year with higher taxable income. And then you can direct the cash to charity at a later date to satisfy any of those charitable obligations you might have. So that's my thought there. Karen, I'm going to pass it back to you for polling.
Thanks, Krista. So jumping into our second polling question, does your estate or your income tax plan, so either at death or during life, does it include a substantial charitable component? So simple answers here, yes or no, or I don't have an estate or income tax plan. Oops, I'm not sure why we just jumped here. Let me go back to that. Did I close it by accidentally? There we go. Oop. All right, sorry about that. So back to the polling. So yes, no, or I don't have an income tax plan. All right, seeing some responses come in, I'll give you a little bit. Go ahead, Andy.
Along this line, I know many of the clients I've talked with this year that do have a substantial charitable component, that 100% of AGI limitation is just almost like a gift that you can't let go by, right?
Huge opportunity there. So it looks like we have the majority of the participants with their answers submitted. So I'm going to go ahead and advance the slide. And it looks like the majority of you either don't have that in your current plan or your estate plan, or you don't have an income tax plan or estate plan. So if C is correct for you, hopefully you have an opportunity following this Tax Summit week to reach out to one of the RSM professionals that you would have met this week. So Andy, with that, I'm going to turn it over to you to take us down some state and local tax considerations.
Right. So I'm going to stick with my theme of kind of the top 3 items in this area that I'm kind of hearing about and talking with people about today. From a state and local perspective, the first one is the pass-through entity tax. So this is, back in November of 2020, Treasury came out and said, hey, a lot of states out there are now providing an election for pass-through entities in order to pay tax at the pass-through entity level rather than paying it at the individual level. Based upon our analysis, we kind of believe that that's deductible by the pass-through entity and not subject to like the $10,000 limit at the individual level. So that's coming up a lot. You got to be careful with it because each state's rules are different. The way that they look at those things is different, and you could find yourself actually paying more tax even though you get it deductible at the federal level. You really have to pay attention to this in the year of sale. That's where probably one of the greatest opportunities is going to reside. It's something that's coming up quite a bit. The second item is relocations and residency. So COVID saw a lot of us figuring out where did we want to work. Everybody got pushed to their homes. Many people wound up moving to other locations. Mobility of the workforce going forward kind of allows us that opportunity. So we're seeing a lot of people make decisions, not necessarily to live in the same location as their business, but to live in other locations. Some of those are tax-driven decisions. We've also experienced a number of people that are getting surprised because they feel like I moved to Florida, my state tax bill should be zero. They're business owners with flow-through entities. And that flow-through income is still going to be apportioned to a number of different states. So you still could wind up with a pass-through with a tax liability. The last one is something that is extremely important dealing with Nexus. A couple of months ago, the Multi-State Tax Commission came out with an interpretation of the Nexus rules that actually the existence of a website that is interactive can create Nexus in a state. So this is something that could have a large impact on clients that are either consumer products manufacturers or distributors or retailers, as well as industrial products companies, where historically they maybe didn't have Nexus in a state where they had sales, so they had nowhere sales. That possibility may be going away in the future to treat sales that way. This will still require states to act, but at the end of the day, it could cause a great change in your state tax footprint, something you need to be aware of. Those are kind of the top three topics here. I'm sure there's a lot more, but I'm going to turn it over to Krista to talk a little bit more about that pass-through entity tax.
Thank you, Andy. Yes, one of my favorite topics. And I'm going to give a plug because yesterday our SALT colleagues gave a terrific presentation on this topic, and they really did a deep dive on it. So I think, if I'm not mistaken, you can go back into the Tax Summit platform where you selected these classes. And if you didn't see that one yesterday, I believe you can watch the recording there. I think it was 2:30 Eastern time. So they did a deep dive. We won't go into specifics here, because there are still, I'll tell you, many questions on how to report the deduction, but it relates to the investment partnership. So in terms of a high-level perspective here, for asset management clients, it appears to be a no-brainer to employ the pass-through entity tax election at the management company level. The question is more on whether a GP entity that is not in a trade or business could take the deduction, or any investment type vehicle where you've got investment income. And when I say take the deduction, I mean take it where it would be useful for the GP partners, for the individuals, right? So because there is a distinction there as to how you treat certain deductions when you're looking at a trade or business versus expenses related to investment income. So that's the fundamental difference there. But it is important to know, Andy, as you mentioned, that IRS notice does not distinguish between different types or sources of income. So, for example, whether a partnership has income from, say, it's a debt fund, and they have portfolio income, interest income, which may not be considered a trade or business for purposes of characterizing the taxable income, or if they have income from a car dealership, right, completely different, which is generally deemed a trade or business, the IRS notice says a partnership, no matter what type, can take a deduction at the federal level for state taxes paid by the partnership. So many practitioners are debating the level of authority that the notice provides. And we've been discussing with many other firms as well to be sure the industry as a whole is taking a consistent approach. But with that being said, we are seeing investment partnerships who are planning to take advantage of this SALT workaround in states who allow for it. So I will pass it, Karen, back to you for another polling question.
Thank you, Krista. So coming up to our third polling question, will you make or have you made decisions related to the state pass-through entity tax election? So simple answers here, yes or no, or is this the first time that you're hearing about this? We know C wouldn't be true if you were attending yesterday's presentation that Krista mentioned. I was also on that presentation. I thought it was fantastic. So just another plug to our SALT colleagues. If you didn't see it and this is an important topic to you, to go back and watch that recording because it really was fantastic. So I'll give you a little bit more time to answer the poll. Getting most of the attendees in. Maybe just a few more seconds here before I advance the slide and close the poll. And let's see where we landed. So it looks like we've got a pretty equal split between whether or not you've heard about this election or whether you haven't. So it looks like we've got an equal split, sorry about that, equal split between people that will be making the election or those that will not. So that's good to know. That means that this is definitely getting out there. People are listening and people are really planning around that. So it's a great response. With that, we're going to shift gears a little bit and we're going to move over to estate and gift planning. And so Ben, with that, I'm going to turn it over to you.
Great, thank you, Karen. So I'm going to spend a few minutes talking about estate and gift planning. First, just sort of level setting where we are based on all the proposals that have come out of DC, and then talking a little bit more concrete around some ideas to think about between now and year end. So just at a high level, I think as most of us know by now, the Ways and Means Committee released their draft back in September, and that included a whole array of changes in the estate and gift world. The exemption, the estate exemption, which today is at $11.7 million per person, it is set to sunset back to about what will be about $6 million in 2026. The proposal was to accelerate that reduction so that it would take effect as of the beginning of 2022. There were also numerous changes that included the elimination of many valuation discounts that are used for when gifting business interests and other interests. There were also some significant changes to the world of grantor trusts. I saw a quick question come through with respect to grantor trusts. The idea there was to essentially eliminate the benefits that grantor trusts have, so that there's an alignment if it's includable. If it's included in the grantor's income tax return, it would also be includable for estate tax purposes, although there would be a grandfathering in of grantor trusts in most cases that have already been established. And that includes, GRATs, grantor retained annuity trusts, and SLATs, which are spousal trusts that many families established over the last several years, beginning in 2012. But as of today, most of those, or if not all of those proposals, are really off the table. And so, based on the most recent sets of proposals, there are really no estate tax or estate tax changes in play. Although, there are some low-hanging fruit or some easy changes that can be made as negotiations continue in Washington, particularly in the area of the estate exemption, right? It's pretty easy. Making significant changes to valuation discount regime or grantor trust regime, those are pretty complicated and not very easy to administer. But the change to the estate exemption is something that's pretty easy and we think could come back. So, in terms of ideas or in terms of things to think about between now and the end of this year, don't forget, as I mentioned, that the estate exemption is set to sunset in 2026 if Congress does nothing. And so, thinking about where you are today at a historical high of $11.7 million, we're really encouraging families that have an objective of reducing the size of their estate and not, for example, passing all of their estate to charity. But if estate tax minimization is an objective, really thinking about doing that as quickly as possible and taking assets out of your estate and investing them investing those dollars in vehicles and trusts that are designed to be excluded from estates. Continued use and continued setting up of grantor trusts is really powerful. The income tax side of estate planning is often forgotten about. But just as an example, Andy, you mentioned before, I keep going back to the surtax, which, we talk about as being applicable to individuals with incomes either over $10 million or $25 million, depending on the threshold. For trusts, those thresholds are quite low. And so that surtax that we talked about, that 5% or 8% surtax, would apply to trusts with income over $200,000 and $500,000 respectively of income, which is fairly low. And so another reason to think about the use of the use of grantor trusts and trying to think through, does it make sense to have that income taxed in a tax-paying trust vehicle or in a grantor trust where it's ultimately taxed to the individual? So thinking through those income tax considerations is also really an important consideration. And we touched on state and local before. Don't forget to think about the state situs of your trust and trying to minimize your state income taxes there either. Governance is also something to really think about, and we're going to talk about this in a bit when we talk about succession planning. But I would be remiss if I didn't mention at least the fact that estate planning is not all about the taxes. It's also thinking through the organization and the governance aspects of your estate plan and of that succession. And so it's really important to think about that in the context of estate planning, is not only to focus on the state and the tax minimization piece, but also thinking about the governance piece. Andy, I know you do a lot of work in this area, thinking about businesses and business owners from an estate planning and a governance perspective. Do you have any thoughts on that?
Yeah, I think, from a business owner perspective, the biggest things right now has been just using your exemption, right? And creating a strategy around how we use the exemption. But then on top of that, these grantor trust rules really paralyzed a large part of the population for a period of time. And the name of the game was really, let's try and move forward. Let's try and get these transactions done before we have an enacted law. But let's also include in there flexibility to be able to undo the transactions. And I think it's resulted in some really good planning for a number of different clients. But it's been hard to keep up with, and hard to get past the paralyzation. I think the other provisions that have been really important are just, it's governance, right? Right, Ben? So as we look at the businesses, and we'll talk a little bit more about this next, as we look at the businesses that are actually transferring from generation to generation, they're becoming larger and larger. And as that happens, we start to run into more things like private trust companies and creating trusts that are going to last for years and years and years and generation upon generation. It adds a lot more complexity into the mix. But it also means that we have to think about even more from kind of a corporate governance standpoint than we did before, which is our next subject. So I'll kind of leave that open and turn it over to Krista and ask her if she has anything around estate and gift planning from a fund executive standpoint.
Yeah, thank you so much. All great points, guys. Very important. I think, Andy, your point on timing, right, and to keep moving forward. So what I'm seeing, the fund managers are still looking at using that classic vertical slice for gifting. So vertical slice is where you're taking a slice or a piece of both the commit and the carry when you're investing in a fund. And so there's rules because you just can't transfer the carry. You have to also transfer a piece of the commit if you do have both interests. So we call that the vertical slice. So fund managers are still looking at that. Of course, you need a valuation there. And Andy, to your point, if we're all rushing at the end of the year, that obviously takes time to do. So I'm seeing a lot of that. I'm also seeing a lot of non-vertical slice structures, which is interesting because you could look at transferring the carry to newly formed partnerships where trust or multiple trusts are the partners of those partnerships. So some interesting and sophisticated planning there. And then I love the other technique, which is using or creating and then I would say selling. So it's a sale of a cash settled option from the partner. Usually you'll do that to a trust for the benefit of his or her children or grandchildren, but that is tied to the upside or downside, I guess, of the performance of the carry. So the cash settled option is interesting because it doesn't involve transferring the actual carried interest itself, and it avoids the vertical slice rule. And at first glance, I know the technique seems like it's really complex, but it can be simple from a practical standpoint to execute. And you'd have to make sure it was appropriate in the right circumstance. But I also think it's a great technique because it gives additional flexibility and it helps when you're planning how much is being transferred at what given time. So pretty cool concepts there. And I'll turn it back to you, Andy, I think we're going into succession planning.
Yeah, we'll finish up the discussion I started earlier. So, when I was preparing for this, it kind of brought up a discussion that I had with a client last week. We're in the middle of trying to figure out how we're going to transfer their business to the next generation and dealing with all the issues that come about there. Just trying to get the first generation happy with the fact that they're no longer going to be, they're no longer going to be the ones in charge. Their children are going to be the ones in charge. Trying to understand who's going to be in what role, what's going to happen, all those sorts of things. And the individual that's going to be the CEO, kind of opened up to me last week and he said, "Hey, Andy, everything that we've been talking about came to life the week before the two of us were talking." One of the uncles had come to him and said, "My daughter's graduating from college at the end of this semester. I believe she should be in a C-level position within this organization." All of the C-level positions were already filled. All of the family members are making the same amount of money. If they're CEO, if they're a manager, if they're a construction manager, it doesn't matter. If they hold the family name, they're making the same amount of money. And this individual had no real prior work experience. The CEO told me, "Hey, we don't have a policy in place for how we deal with this situation." So I was left of my own accord to have to tell my uncle, "Hey, your daughter isn't really qualified for a C-level position within the organization," which of course then creates ill will, makes the family hard to, it'll probably make this Thanksgiving a little hard for the family. It's the right answer for the business, but all of it, the individual told me, could have been avoided had we kind of listened to some advice we'd gotten a year earlier and sat down and developed kind of a plan for family employment. So looking at the way that we're going to evaluate these people, bring them on board, and then evaluate their performance after they're already there. But it's not necessarily just about that situation, but it's about the importance of kind of having these discussions very early on. Dealing not just with the tax ramifications, as Ben was talking earlier in an estate tax context, but also dealing with those governance issues. It's an issue I've dealt with just about every transaction that I've been dealing with lately, so it comes up quite a bit. The other one that we're dealing with quite a bit is passive investors. So as I mentioned earlier, the organizations that are transferring within a family are becoming larger and larger. It's no longer the mom and pop shop that's up the street. It's a multi-million, multi-billion dollar industry that's transferring from generation to generation. That means oftentimes the only way to make it happen is to admit that we're going to have passive shareholders. Sometimes we try and avoid it, but sometimes we can't. What I always try and talk with clients about around that, and it's been working very well, is treat it like you would any public enterprise. Most public enterprises are going to have distributions. They're not going to pour everything back into the organization and look at compensation as what the investors get. They're going to treat all of the employees the same way. So they're going to look at their performance and they're going to pay them based upon what their role is. All of these things are really important as we look at those larger businesses and transfers within the family. So I think those are two of the biggest issues we've been dealing with from a succession plan standpoint. I'd say transfers within families aren't as common as they used to be. I think many of our transactions today are with third parties. They're with private equity or they're with management. But when they do occur, as I said, the organizations are much larger. It's much more complicated. And these are the issues that we have to deal with that, years and years ago, we didn't have to deal with because we were dealing with much smaller companies. So Ben, I know your client profile looks a lot like mine, and I'm sure you're dealing with a lot of these same issues. Are you seeing anything different from kind of what I described from a business owner standpoint?
No. So Andy, it's a good question. So as we talked about, most of the families I work with are large families and family offices, but roughly 2/3 of the family offices we work with have operating businesses, right? And so, but even for the ones that don't, even for the 1/3 that don't, a lot of the same issues. You're dealing with large, complex organizations that, need a succession plan regardless of whether they have a business or not. I generally look at the different buckets of a family, really three main buckets. There's the business, if there is one. There's the personal investments or assets, and then there's the charitable organization. And really all three need a solid succession plan for the future in order to be successful. And in addition to having the plan, it's really important, as you mentioned, to have that intra-family communication on a regular basis and be open about things. The last thing you want is to, God forbid, pass away and leave, significant investment pool or, charitable vehicle without a clear succession plan, from a governance perspective, in place, and the family is left sort of trying to figure out what to do. And having that smooth plan will allow the family to achieve success and truly, understand what the family goals and objectives are all about. So I would say, having a family think about, and it's really interesting, it comes into play with a business that's going through a liquidity event where maybe the family never had significant liquid assets. And all of a sudden they go from having a business to having a significant pool of investable assets and maybe a large charitable vehicle like a private foundation, and not really thinking about those assets as they did the business. And it's important for us to work with families to have them, give as much thought and attention around those as they did their business. And the families that do that ultimately are really successful. Karen, Andy, unless you had other comments, I think we're going to go back to Karen.
All right, Andy, I'll give you a moment and see if you had anything. Otherwise, we'll transition to our next polling question. So for the succession planning that we were just speaking about, does your business or your family office, will it experience some sort of transition in the next 5 years? So a simple yes or no question here as you consider thinking about succession. And I think I like the 3 legs of the stool that Ben had thought about. So maybe you don't have a business, maybe it's just some family considerations that you have when you're thinking about succession. So we'll go ahead and give it a few moments here as we sort of wind down on the time that we have with you today. I think we'll have one more polling question as we close out. A couple more moments as we get more attendees answering the polling question. Getting there. And so with that, I'm going to go ahead and advance that forward. So looks like we have another pretty equal split here, a little bit more for the no's, that there is not some sort of transition plan in the next 5 years. So Ben or Andy, as we reflect on the responses here, any thoughts or reactions to what you see? Probably not a surprise, sort of like estate plans and succession. That's sometimes the last thing that people think about. So I don't know if you have any comments here.
No, I think that point is well taken. There are certain transitions that are planned, and then there are certain transitions that are unplanned. And the idea here is to obviously make sure that as best you can, plan for the, plan for things that you're not really expecting to happen. And sometimes that's, when the worst things happen is when things unexpectedly happen and there's no plan for it. But, we have seen a lot of families really react very favorably, especially as we share best practices and ideas with families, with each other, to really, get that line of communication going between the family members, particularly between the generations, because all of the planning that they're doing, whether it's the estate planning, whether it's the succession planning we're talking about, really all works together with and proper planning is really very, very effective when you have that line of communication open that's going very well.
I'd also add, I think you're absolutely right, Ben, and I'd also add 43% of respondents believing that there will be a planned transition in the next 5 years. It's an awfully high number when you consider the population, right? Mm-hmm. So, the economy is going to be undergoing this transition. It's going to be important that everybody kind of plan for it. So with that, Karen, maybe we can move on to the top 5.
Right. So as we wind down the presentation and our time that we have with you today, we wanted to leave 5 things that we would like to imprint into your memory just as our time together. And so the first thing that we'd like to think about is we talked about charitable giving. When you're starting to think about your strategy and your plan, we illustrated some statistics around, is it more valuable to give during your life versus at death? And so as you examine your strategy or as you start to put that together, really think about the timing, whether or not it would be more valuable during your life versus at death. The second thing we'd like you to remember is as a result of COVID and other things that are happening in the world, we've had a lot of movement. So really take another look at your state and local tax profile. Really understand maybe the times that you've spent maybe in a vacation home or traveling, and what that may have looked like for you quarantined, and how this is going to impact you just from a tax profile or tax footprint. The third thing we'd like for you to remember is, should the proposed individual provisions make it into law, and granted this is when we were talking about the billionaire tax plan, examining your organizational structure may be a good idea. So thinking about pass-through versus corporation. And so a lot of those individual provisions that would impact you from a flow-through perspective, really doing an analysis to understand from a structuring perspective, does C Corp make more sense than a flow-through structure? Leaving the tax issues aside, making sure that you're considering all of the variables and not just making this just purely on a tax decision. The fourth thing we'd like you to remember is to really think about measuring your wealth and using your lifetime exemption. Ben had mentioned earlier in the presentation that if nothing happens with respect to the exemption amount in some of the tax legislation, that it will sunset. So you got to use it before you lose it, and really taking time to figure out what is your current state and what you need for your lifetime and what you want to give away. And the last thing is really time is of the essence. We know that we've got a ticker here when we think that tax legislation is going to be put into place. Some of the gifting strategies that we talked about may require evaluation, and we know that takes time. So really thinking about time is of the essence and being proactive versus reactive as we really look at what may be coming down in Washington. Leaving you with those 5 things, I'm going to go ahead and shift it to our last polling question. And that last polling question is a simple question of, I can get it to move. Would you like to talk more about this topic with any of our RSM professionals? So very easy yes or no question. And with that, we're going to leave this question with you. I'll give you a few moments in case you missed one of the polling questions along the way. This is your bonus number 5, just like we had the 5 takeaways. So maybe we've got a theme of Andy likes 3 top topics. We've got 5 takeaways. I'm sure there's a 4 somewhere in the middle. So give you a couple moments to answer this last question. Got a few more responses coming in. And let's see if we can get closer to 80%. I don't want to shut anybody out of the last polling question just in case they need it for their CPE credits. And as this question starts to wind down, I just want to say a big, huge thank you to all of you for joining us today. We really do appreciate and love the opportunity to be in front of you to talk about tax planning. We know it's really been an uncertain year, and so hopefully some of the topics that we brought to you today give you a different perspective or help to shed a little bit of light over what you're hearing with all the movement with tax legislation. So again, just a really huge thank you. Thank you for attending our Tax Summit this week, and we'll see you all again soon.
Thank you so much, Karen, and thank you to all of our presenters today. A reminder that you can join our presenters in the networking lounge immediately following this event to continue the conversation on this topic. And of course, we invite you to participate in our final event for Tax Summit Week coming up at 3 o'clock this afternoon, Full Speed Ahead Year-End Tax Planning. In the meantime, you can download a copy of your certificate by visiting the Certification Center and clicking the download icon. Be sure to save a copy to your computer in the next few minutes before we conclude our event. We also invite you to take a moment to participate in the attendee survey by following the link in the resources list to the right of your screen. Thank you so much for joining us, and we look forward to participating in our final event for Tax Summit Week.